Hey folks, here is I am a star when I recognize revenue. We'll start with the I. I is identify the contract with your customers. And when you identify a contract with your customers, you're looking at an agreement between a customer and an entity to exchange consideration for your goods and your services. So this is your ordinary inventory, your ordinary services that you will be selling, and there's now an agreement between you and the customer. You have to make sure that it's identifiable, and notice the word enforceable. You have to have enforceable rights and obligations. This is the area that has the term enforceable in it. You have to be able to identify the payment terms. It has to have commercial substance. In other words, it exists in the area of commercial substance so that future cash flows are expected to be exchanged and received, and it's probable that the entity will collect their money. Now, if there is no agreement, somebody does something on good faith, then you'd have to wait until actual payment is received and you've provided the service and there's no obligation to refund the money. But that's only if there was never an agreement. So hypothetically, a client of mine says, hey, I know the boss is on vacation, but we really need you to do this. They can't sign it. We can't reach them. They're in a far off land. Would you just do this? And I promise we'll take care of you later. So I do it in good faith. Under those circumstances, without that enforceable agreement, I've got to wait for payment for those services delivered where there's no obligation to refund the money. But general rule, you want that contract, a contract between the customer. Now, if there's not a contract, there could be a general contract or a general understanding with a purchase order. So it could be on another means, very, very similar with many companies where you literally go on their website, you click, you gave identification numbers, you click, I agree. That's good enough. All right, that's the I. Now let's go to the S. We're going to separate the performance obligations. In the old days, we used to call this a multiple element arrangement, and these were the deliverables, or as I like to say, the stuff you're going to do. You got to be able to separate the different stuff. And the reason you want to do that is because of the rule of conservatism. The rule of conservatism says, thou shalt not recognize any revenue until the earnings process is virtually completed. Well, let's say you're going to do three things. We'll pretend that you're in a computer company and you're going to design software, you're going to install it, you're going to train their people, and you're going to offer 2 years of service. Well, that's a lot of stuff you're going to do. And in theory, when you wrote the software and they paid you some money, it's not revenue under the basic rule of thumb. Why? Because you still have more stuff to do. So you would debit cash if they paid you and credit a liability account called deferred revenue or unearned revenue. It's a liability. Later on, when you delivered the software and installed it and they paid you more money, same thing again. You still have more stuff to do, so you couldn't recognize revenue. Even if they paid you, you debit cash and credit another liability, deferred revenue or unearned revenue. Later, when you trained their people and they started using it and they paid you more money, same thing again. No revenue, you still have more stuff to do. Well, you get the idea. This is not what management wants. So we are allowed to break up the stuff we're going to do into bite-sized pieces. And we can recognize those bite-sized pieces as revenue. So we have to look to see how to break them up into bite-sized pieces or separate those performance obligations. So performance obligations are your promises to transfer goods and or services to the customer. There may be only one single performance obligation or one single distinct obligation. Single obligations when service or goods are substantially the same and transferred in the same manner. So maybe it's you're going to literally deliver a basic, Microsoft Office and you'll install it for them. So it's in one fell swoop. Distinct means the promises are separately identifiable from each other and that they can be used independent of each other. So as long as you can break them up because they're independent, and typically you define independence as you sell these items separately, your competitors would sell these items separately, or the customer could use that separate item all by itself and wouldn't need other items from you. So now you've broken up and separated the items. Then we go to the T of I am a star, ST. and that's the transaction price shall be determined. The transaction price is the amount of consideration, and listen to this phrase very carefully, the entity can expect to receive. Notice we're not using the sacred cow, reasonably assured of collection. This is the amount you expect to collect, which means you can factor in if you anticipate that you'll receive a bonus or that there may be a penalty for delivering after the appointed time, or there may be a time value of money discount where if they pay quickly, they can take a 2% off. So you have anticipated what these amounts are. This is a side calculation that you're doing so that you're factoring in the amount you expect to receive for the services that you've transferred, whether it's goods and or services. This price should take into account variable consideration. As we said, penalties and bonuses that you believe you're likely to have, significant financing. Typically, if the payments aren't due for more than 1 year, then it's had to be discounted. And if it's non-cash consideration, they're going to give you stock in their company, or they're going to give you a piece of land that they don't need but you desire. Then, of course, it's going to be the fair value of that piece of property or that fair value of that stock that they're going to give you. So therefore, we have I am a star, IST. Now we're going to allocate it. Allocate the transaction price you just computed, allocate it to the stuff you're going to do, the separate performance allocation or performance obligations. Allocation of the transaction price is needed when a contract has more than one performance obligation that needs to be performed. The allocation is based on the amount of consideration that would be expected for the satisfaction of each unique obligation. So typically, you're going to take the standalone prices if you have them, and that can be based on identical, similar, or unobservable inputs, and then you'll allocate on a pro rata basis. Now, if there's a special bonus or a special penalty that directly relates to one specific performance obligation, you should allocate it to that. So factors in the application, discounts, variable consideration, and transaction price changes should all be factored in. So that's the A, allocation. And then the final one is the R, recognize revenue. For each separate performance obligation, each bit of stuff, as you complete that stuff. So the entity, as they satisfy each separate performance obligation by transferring their goods or their services to the customer, that's where the customer obtains control. And think of that as your risks and rewards have been transferred to the customer. Satisfaction can occur over time, such as a magazine subscription or insurance that will cover you for multiple periods. It could be also a health club membership where you'll have it for a year, or it could be a point in time. Point in time might be when I go to the grocery store and pick up a gallon of milk. It's when I'm standing at the cash register. They recognize that revenue. Same thing with a drugstore or a doctor's office. When you go in and you have an exam, that's when they charge you. So if it's recognized over time, then you have to determine, will it be on an inputs or outputs method? And I'll give you an example. Outputs. I subscribe to the Wall Street Journal, and every day I get it, 52 weeks a year. Well, each day as they deliver it, they can recognize 1/365th if it was delivered every day. Of course, most of the time it's only once on the weekend, but you get the idea. On the other hand, inputs might be an accounting firm. For every hour they put into doing the audit, they will bill the client. So it could be outputs method to determine how to recognize revenue over time, or it could be an inputs method of how you recognize revenue over time. And if it's recognized at a point in time, recognition will occur when the customer, and here's that famous phrase again, obtains control, which essentially means that we're going to have a situation in which risks and rewards have been transferred to them. Now, one interesting thing that came in the guidance, and I just want to remind you of this, they actually have one small section after I am a star. And by the way, does Peter have messed up hair there or something or other? I don't know. Is that Pete or is that somebody else? I don't know, but they're ranking Pete at 10, which I believe he deserves with his quality of teaching. Well, anyway, going back to this material, they actually cover basics of cost, and they have two areas you want to be familiar with. One is the incremental direct cost to obtain the contract, You capitalize those, and notice it's incremental direct. Incremental direct would be those costs that are only incurred because the contract was obtained, such as the commission that a salesperson would get. Right? That would be a classic example. Notice their base salary would not, because their base salary they would incur regardless of success or failure in obtaining the contract. So incremental direct cost shall be capitalized, and then under the matching principle, they will be amortized over the revenue stream. That's typically required unless the contract is less than a year. The second type is the cost to fulfill the contract, which you'll know this one. It's material, labor, and overhead. Those items are capitalized as part of your inventory, and then they are charged off as cost of goods sold when the revenue is recognized. So those are some of the fundamentals that we want to remember as we go into this area. Hey folks, what I'd like to do now is just kind of show you an illustration of how this works. And frankly, this is something that I have presented to major corporations as they were reviewing and trying to grapple and understand the brand new revenue recognition rules when they were first issued. And people saw the 5-step approach, I am a star. But, they kind of got scrambled up in the eggs here. So I kind of showed them this methodology we use. So we're going to start at the top, and I'm going to ask my good friend, Sugar Bear Olinto, to help me out. And Pete is wearing his leprechaun outfit to exploit his partial Irish heritage. I bet you didn't know that. Well, Pete's sitting there, and he's got the pot of gold in front of him. That's the amount you expect to be entitled to, which is actually step 3. We've done that calculation. Now, step 4 says you allocate that pot of gold back to step 2. So let's say we have 4 performance obligations. So you'd allocate based on either identical items that value each one of them, or similar items, or estimated unobservable inputs. So we had 4 separate items. We came up with each of their values, and then in proportion to each other, relative proportion, we allocated that pot of gold to each one of those items. That becomes something known as a revenue constraint. That's the maximum amount of revenue that can be ultimately recognized when that separate bit of stuff, that performance obligation, is done. So each of them now has a dollar amount associated with them. Now we go to step 5 and we recognize revenue. We recognize, and now you're to that old favorite term of an accountant, reasonably assured of collection. So we're going to recognize reasonably assured revenue. And you have an option. Is it point in time or is it over time? Remember, point in time might be a grocery store when you're buying milk. It might be a drugstore when you're buying shampoo. It might be a medical service when you actually went to the doctor and had your annual exam. On the other hand, over time might be a magazine subscription. It might be an internet subscription for a year. It might wind up being a health club membership for a year. You get the idea. And remember, it's using inputs or outputs as an option to show how far the progress has gone. Note, by the way, performance obligation number 1, hypothetically, might be point in time. Obligation number 2 might be over time. Obligation number 3 might be point in time. And obligation number 4 might be over time. Each one will have its own distinct revenue recognition methodology associated with it. So if you want to kind of follow the flow of I am a star, this kind of shows you then, after you've gotten all that information, here's how you kind of view it in its entirety. We have Pete having that expected amount that you're entitled to, allocate it to the stuff you're going to do, and then as each bit of stuff is being performed, determine if it's point in time or overtime, and then recognize the reasonably assured revenue. Hopefully that gives you a nice warm-up, and we're ready now to try some exercises.